Welcome to this video on the topic of investment appraisal. Specifically, we're going to look at discounting methods. There are two main methods that are used in this context. One is the net present value method and the other is the internal rate of return. We'll see later that in fact they are related. However, we will deal with the internal rate of return in a different video. But for the moment, it's worth noting that these are the two big names. These methods take into account the total returns from a project and also, and this is a critical point, also the timing of those returns. Clearly, the returns on an investment received early are preferable to returns received later, and therefore timing is crucial. The returns received earlier have the following advantages. First of all, the money may be reinvested at a rate of interest, thereby boosting the future stream of income. It's possible that if the return on the investment comes in early, that money could be put to work elsewhere. I'll just put the cursor on the screen to show where we've got to. The money may be invested in a new capital project. Well, that's possible. So it may be that one capital project, because it's giving early returns, could go to finance a second one, a related one perhaps. Certainly an early stream of income will ease any cash flow problems and be very welcome on the cash flow front, because the business must pay its day-to-day bills. Early returns also reduce the risk of the investment. The further into the future the returns are, the more risky they are. We don't know what the future holds. We don't know what it holds in terms of investment, technology, innovation, government policy. We don't know. So the future is uncertain, and the further out into the future, the more risky it is. Also, the fact is that returns stretching out into the future may be affected by inflation. We don't know what the course of inflation is, but if the returns are affected by inflation out 5-10 years from now, we don't know what that's going to mean. And it will certainly affect the value of the returns. We also say that we have positive time preference. This is a very important term, positive time preference. Simply put, given a choice between, let's say, £100 now or £100 in a year's time, you will prefer to have the £100 now. Generally speaking, we have positive time preference. We prefer returns now, not in the future, but now. So in order to get us to save, we must be compensated to overcome our positive time preference. So in order to get us to save, the banks give us a rate of interest to encourage us to save, to overcome our time preference. So we don't like waiting. That's the point. Now, the returns on investment usually stretch into the future. Given the fact that we like early returns to late ones, the early returns have a greater weight, a greater importance as compared to the returns in later years. Now, there are two ways of calculating the net present value, which is the present value of the future stream of income. We can do it by formula or by table, or by tables. We'll look at these very briefly to see how it works. Let's look at the formula for a start. Imagine, I'll put the cursor back on the screen. Imagine you put £100 into the bank at 10%. At the end of the year, you would have £110. 10%, £100, £110. Now, if your rate of time preference is 10%, in other words, you need 10% to compensate you for saving, for not spending the money now, for having the money in a year's time. If your rate of time preference is 10%, this means that you will be indifferent between £100 now or £110 in the future. Either of them would be good for you, because £110 in the future to you, given your time preference, will be exactly the same as £100 now. You've been compensated for waiting. In other words, the £100 now is the same as £100 in a year's time. Now let's look at the way this works with a little formula. Here's the amount and here's the principal, P. This is the amount we get and this is the rate. Now let's say we put £100 in the bank. It's our principal, £100. We would get 1 plus the rate of interest, 10%, which is 0.1. 1 plus 0.1, would you believe, is 1.1. Easy. So we have equals 100 times 1.1, which is 110. So if we put £100 in the bank, it'll grow into an amount in the future of 110 after a year. If you left this £110 in the bank for an extra year, then it would grow by another 10%. So we'd have £110 growing by 1.1, which would grow into 121. In other words, £100 left in the bank for 2 years, earning 10%, will grow into £121. Let's do that again. Start with £100, put it in the bank for 1 year at 10%. The amount we get back is equal to the principal, £100, that's what we put in, times 1 plus the rate of interest, 10%, 0.1. £110. Now leave the £110 in the bank for a further year at 10% and it'll become £121. Now we could write this as follows. A equals the £100 we put in times what we get back after the first year and the second year. R is equal to 100 times 1 plus the rate of interest, 0.1, 1 plus the rate of interest squared. That term and that term are identical. So when we multiply them together, it becomes a square. This is the start of our formula. If you left your money in the bank for n years and the rate of interest remained the same at R, your money would become A equals 100 times 1 plus R to the power of n. Or, if you like, A equals P times 1 plus R to the power of n. And that's our general formula for any number of years. This means that the present value of a sum of money to be received in the future is given by the formula that. Well, if you look at this formula up here, if we divide the right hand side by 1 plus R to the power of n, then we must divide the left hand side by 1 plus R to the power of n. So A divided by 1 plus R to the power of n is equal to P. And this means P is the present value of the stream, A is the sum received in the future, R is the rate of interest, and N is the number of years. That's our formula. Let's look at an example. What's the present value of £100 to be received in 2 years' time if the rate of interest is 10%? 2 years' time. Well, put it into the formula. P equals 100 divided by 1 plus 10% squared, which is that, which is over this, which is £82.64. So £82.64 is the same as £100 received in 2 years' time if the interest rate is 10%. Example 2. What is the present value of £100 received in 2 years' time if the rate of interest is 5%, together with a sum of £200 received in 3 years' time? Well, it's the same formula. £100 5%, and we get that in 2 years. So the little term here is 2. Plus, we get £200 after 3 years, 5% there. If you evaluate that, you have to multiply out using a calculator or a spreadsheet or whatever. If you multiply it out, you get £263.47. So this sum of money, this stream here, is equal to £263.47. We can do this by table. This is what a table would look like. Here we have the number of years down here, and here we have rates of interest 2, 4, 6, 8. Just we could have 1, 2, 3, 4, whatever. These tables can be purchased. Sometimes they appear in the back of finance books. You can get them online nowadays. So they're fairly easy to come by. If we take a year, say 2 years at 2%, the multiplying factor is 0.9612. If it was 8%, it would be 0.8573. The table should be read for a given number of years and a given discount rate. And let's look at this example, the example I cite here below. Example, let's say we want to know how much money we need to put in the bank today in order to get back £100 in 4 years' time. Let's say that the interest rate is fixed at 6%. Obviously that's not very realistic, fixing a rate for 6% for such a long time, but never mind, let's just say it's a question. Now, it looks pretty daunting as a question until you realize how simple it is when you use the table. Look at the table. First of all, we're going to have £100 for 4 years. So we'll go 4 years, it's £100, and the interest rate is 6%, so it's over here. 0.7921. So you multiply 0.7921 times the 100, which is £79.21. This means that we would have to put £79.21 in the bank for 4 years at 6% to get back £100. Now let's just calculate out of a table, which are, you can find those tables quite easily. Let's have a different example. Again, this one sounds horrendous until you start to realize how simple it is. A company is considering the purchase of a piece of capital costing £100,000. It uses an 8% discount rate. So the company wishes to use 8%. It might not be the rate of interest, but it's just what the company wants to use, 8%. If the equipment yields a return of £30,000 over a 5-year period and has a scrap value of £5,000 in the 5th year, is it worth buying this equipment? Well, if you write down what we know. We know that it's 100,000 going out, so it's minus 100,000. And then we get 30,000 in each year for 5 years, and 5,000 at the end, scrap value. Now, looking it up in the tables, if you go back and say, okay, the first year it's at 8% and 1 year. Let's go back to the table in the previous slide. 1 year, 8%, 0.9259. 0.9259. Try to remember that. 0.9259. 0.9259. There it is. So you simply take that and multiply it by the 30, which gives you 27.78, and do it for each one all the way down. This one is 30,000 in the 5th year and a scrap value of 5,000, so it's the same figure. And just tot the whole thing up and you find it's 23.81. This figure is positive, and therefore it is profitable to purchase this piece of equipment. So a problem which looks very, very difficult is actually quite easy when you write it down in this format and think logically about how it works. You could use the table or you could use the formula. It's easier to use the table when you have a long time period like we've got here. So that's an introduction at least to the net present value. As I said at the outset, the internal rate of return will be dealt with in a later or a different video. And this about concludes all I want to say about the net present value at this time. So thank you for watching.